Wake up, everyone, shake off the cobwebs and get your head in the game. Because today I am cutting through the noise to talk about the kind of silent market earthquake that changes the landscape forever. While the mainstream media is obsessing over stock tickers, CEO puff pieces, and everything is fine forecasts, the Japanese government bond market has just hit a wall. I am not talking about a little volatility. I am talking about a structural fracture disguised as a market correction. By the time the exit doors slam shut, most people are going to be left wondering what hit them. Let us look at the big board. The Japanese bond market is a load-bearing pillar of global liquidity. Trillions in leverage, collateral, and safe assets are built on top of it. What we are seeing now is a clear warning that pillar is cracking. Most people don't get it when a G7 bond market goes haywire. It doesn't stay local. It goes viral, spreading to other debt markets, currencies, commodities, and yes, precious metals. I want to hit 3 points hard today. First, the reality of what's happening in Japan, ignore the mainstream spin. Second, the contagion to US treasuries, where the real-time bomb is ticking. And third, silver, why it's ripping, and what happens when the dam finally breaks. Let's cut the BS. People think Japan has maintained low rates for 30 years because of some magical economic resilience. Wrong. It's an addiction. The entire system is chemically dependent on cheap money. When your national debt is multiples of your GDP, you cannot afford market rate interest, period. That is suicide. Low rates aren't a policy choice anymore. They are a survival requirement. This is why the super long end of the curve, the 30 and 40-year bonds, is the kill zone. Everyone watches the 10-year, but the long bonds are where the borrow forever fantasy dies. Pension funds and insurers loaded up on this paper because they were promised it was safe, stable, and liquid. And it was, as long as the central bank was propping it up. But when yields spike, these institutions aren't facing abstract risks, they are facing massive holes blowing through their balance sheets. When bond prices tank, capital buffers get vaporized, and risk management departments scream sell. And here is the trap. When everyone tries to sell the same asset at the same time, liquidity evaporates. Before the news anchors call it a crisis, the early warning signal is always the death of liquidity. The auction block is the moment of truth. It's not a chart you can paint, it's real money. If the auction fails, dealers get stuck with bonds they can T-sell. They dump them to hedge, yields spike higher, and the death spiral begins because nobody wants to catch a falling knife next time. Sovereign debt is a confidence game. It runs on faith. Investors need to believe the government can pay and the currency won't turn to confetti. But once that faith cracks, no amount of official speeches can fix it. But Japan has survived this before. You say, not in this world. The era of low inflation, low volatility, and geopolitical peace is dead. We are in a world of weaponized supply chains and energy. Inflation is gone. It's just reloading. In this environment, bond buyers demand a risk premium, higher yields, which is exactly what these debt-laden governments cannot afford. Now pivot to the US. This is the critical domino. Japan's foreign reserves aren't just numbers. They are ammunition to defend the yen. If the yen collapses, they have to intervene. That means selling foreign assets to buy yen, and what's the biggest asset they hold? US Treasuries. Japan is trapped. Save the bond market and let the yen crash, or save the yen and dump us treasuries. Either way, global yields scream higher. And when US yields rise, everything breaks: real estate, corporate credit, government deficits. High interest rates are no longer a spectator sport. They are the main event. Let us talk about the carry trade, the invisible engine of global asset prices. For years, Japan was the ATM, borrow cheap yen, buy high-yield assets elsewhere. It's free money until volatility hits. If yields rise and the yen swings, that trade unwinds. It's a forced liquidation event. Stocks, credit, emerging markets, everything funded by cheap yen gets hit. This is why Japan isn't a local story. It's the butterfly effect for the entire global margin call. Imagine you a Japanese insurer. Your domestic bonds are tanking. Your risk alarms are blaring, and you need to de-risk. What do you sell? You sell what's liquid. That means US Treasuries. So you get this paradox. The US economy might be cooling, but yields keep rising because it's not about growth. It's about forced liquidation. Now, bring in silver. This rally is not just industrial demand. It's monetary panic. If this were just about solar panels, the chart would be a slow climb. This explosive move, that money fleeing a burning building when the bond market, the supposed risk-free foundation, starts shaking, capital runs to assets that don't rely on a politician's promise. Gold is the king, but silver is the volatile squire that steals the show in a crisis. Let me be blunt. Screen prices and physical prices are divorcing. Paper silver is infinite, just click a mouse. Physical silver, you have to mine it, refine it, ship it. There are hard limits. When demand explodes, the physical market goes no bid, meaning premiums skyrocket and delivery dates vanish. The smart money doesn't wait for the headlines. They position themselves when the price looks boring. You ask, why $100 silver? Because it's not just a number, it's a psychological breaking point. At $98, people hesitate. At $101, the paradigm shifts. Shorts are forced to cover. Trend followers pile in, and the media creates a frenzy. It ceases to be a trade about fundamentals and becomes a trade about emotion and flow. It's a classic squeeze, and silver is primed for it because the paper market dwarfs the physical reality. Don't forget collateral. Bonds are the plumbing of the financial system. When bond prices fall and volatility rises, the value of that collateral gets a haircut. Borrowing costs go up, and liquidity vanishes. In a liquidity crunch, people sell what they can, not what they want. That's why you see weird days where gold and silver drop with stocks that the system liquidating. But then, the snapback happens. So, here's the cliffhanger. If the Bank of Japan tries to cap yields and fails, the market realizes the emperor has no clothes. The game rules change from management to crisis of trust. Here is a mental framework to keep you sane when things get crazy. Scenario 1. Japan prints enough money to hold the line, soft landing miracle required. Scenario 2. They save the bonds but sacrifice the currency, yen crashes, gold and silver moon. Scenario 3. Yields spiral out of control, triggering a global margin call and international intervention. All roads lead to a loss of faith in paper promises, which means hard assets win. And let's not forget the demographics. Japan is old. People live on fixed income. Rising yields sound good until they destroy the principal value of the bonds you hold. That is the pain of normalization. You can't restart the cycle without incinerating the old assets. Back to silver's fundamentals. The macro is the ocean, but fundamentals are the shoreline. Industrial demand is real and unyielding. You can't print silver. Mines take years to come online. When investment panic meets industrial necessity, the market snaps. But they'll find substitutes. Not overnight, they won't, and not without massive cost. A piece of advice many influencers won't give you. If you want physical metal, don't wait for the perfect dip. The best time to buy is usually when it feels uncomfortable, before the crowd arrives. The bond market signals tell me the window for quiet accumulation is closing fast. Look at the US long bond. Yields are hitting critical levels. This isn't just about bonds, it's about the valuation of every asset on Earth. Real estate, stocks, debt, it's all priced off the risk-free rate. If that rate spikes, everything reprices. But there's a nuance. If yields rise because of growth, we can handle it. If they rise because investors are demanding a risk premium for holding government debt, that is systemic poison. Can the Fed fix it? Sure, they can print money to buy bonds and cap yields. But that is yield curve control. It's an admission that the free market is dead. And that is the ultimate buy signal for hard assets, because it signals they will choose inflation over a hard default. History teaches us that suppressing markets only builds pressure. Japan held the lid down for decades. If it blows now, it won't be a gentle steam release. It will be an explosion. Don't be naive. Crises aren't overnight events. They are processes. The market breaks. Authorities react. The market panics. Authorities pivot. Watch your dashboard. How fast do yields snap back? What is the yen doing? Are credit spreads widening? Is the physical premium on silver rising? These are your real indicators, not the headlines. I've seen this before. I've seen people mock precious metals right before the currency turns. I've seen safe assets become toxic. The crowd turns fast. I don't need a consensus to act. The bond market is screaming, and behavior is the only truth that matters. For silver, I see two paths. Path 1. We smash through the round number, trigger a massive squeeze, and then see a sharp pullback, the classic blow off top. Path 2. We break out and grind higher as capital systematically rotates from bonds to commodities. If the bond market stays broken, Path 2 is more likely. I'll leave you with two questions to fight over in the comments. First, do you think Japan can stabilize its bonds without crashing the yen? Second, when silver breaks the next big level, does it squeeze or stall? I read your comments, and they shape the next broadcast. And a final thought, if Japan dumps us treasuries and the US responds aggressively, what happens to the dollar? Being the reserve currency is a superpower, but it's also a trap that tempts you to print your way out. The longer you abuse the privilege, the harder the reset. That's why I watch hard assets, not just currency pairs. Some say, buy stocks to hedge. Maybe at first, but if yields are rising due to a debt crisis, stocks get crushed by valuation compression and higher borrowing costs. Sell bonds, buy stocks might be the trap of the decade. I prefer assets that don't have a counterparty. Why isn't everyone talking about this? Because most people only talk about the explosion, not the fuse. But that's your edge. Understanding the mechanics keeps you calm when others panic. Gold or silver. Conceptually, gold is the shield. Silver is the sword. Gold moves first. Silver moves furthest. In a world of debt and doubt, you need both. Let's wrap this up with some humanity. When bond markets break, it starts with numbers and ends with people. Mortgage rates spike. Pensions get cut. Cost of living soars. It becomes real life. The sooner you see this coming, the better you can protect your family. If you've lived through inflation or currency devaluation, share your story below. People need to know this isn't theory. Watch the language. Ensuring market function means liquidity is dead. Monitoring volatility means they are scared. Prepared to act means they are already too late. Yields lead, language lags. Japan is the canary in the coal mine. The pressure is transferring through risk desks and algorithms globally. When trust in sovereign debt fades, hard assets are the natural recipient. Silver, being small and emotional, will move faster than you think. Bond vigilantes are back. They aren't villains. They are just investors refusing to lend money at a loss. They are voting with their wallets. Governments can fight them, but the cost is inflation. It's a dead end. If you still listening, you here for understanding, not clickbait. This system is exhausting, I know, but understanding gives you power. If you got value from this, subscribe and drop a comment to help the algorithm find others who need to wake up. Final suspense. The bond market is forcing authorities to choose between a depression and inflation. It's not a hypothesis. It's happening. They almost always choose inflation, and when they do, the metals will ring the bell. Don't let daily volatility shake you. Look at the system. Look at the debt. The math doesn't lie. Take care of yourselves and take care of each other. See you on the next one. Disclaimer: this content is for information and education only. It is not investment advice. Do your own due diligence.